Welcome, everyone. Thank you so much for joining us this afternoon. My name is Nikita Desai. I'm the Director for Policy and Corporate Programs here at the Korea Society. And today's session is Year in Review, Korea and Regional Markets. It's my pleasure to introduce our speaker, Koshy Mathai, Deputy Division's Chief in the IMF's Asia and Pacific Department, covering Korea and Mongolia. In the last few years, he's led missions to Maldives and Fiji and served as resident representative to Sri Lanka. Earlier in his career, he worked in the Fiscal Affairs and Western Hemisphere departments of the IMF. He's been at the IMF for 17 years. We're very happy to have him here. Thank you for joining us. And our moderator this afternoon is President of the Korea Society, Thomas Byrne. He previously was the regional manager for Moody's Sovereign Risk Group, covering the Asia, Pacific, and Middle East regions, based in Singapore. So I'll turn it over to you, Tom. Thank you.
Okay. Well, thanks, Nikki, and thank you all for coming this afternoon. And it's good to see Koshy again. I first met Koshy in the Central Bank of Sri Lanka when I was before my Korea Society days, working with Moody's when we were rating Sri Lanka's bonds. Well, when I was thinking about this program today, I was actually pretty depressed because my framework for the world was, of course, anchored on what we think will happen in the U.S. And the Federal Reserve Board back in September issued its June forecasts, and they see U.S. economic growth, which, of course, for a long time, other than China perhaps, was the one engine that was really driving global growth. Only 1.8% in 2016, and going back down to 1.8% in 2019 and over the longer term, and bouncing up a little bit to 2.0% 2018 and 2019. So, you know, that's pretty depressing, I think. However, this morning, I got some cheer. Maybe it's that time of year. And I was listening to Bloomberg, and Kenneth Rogoff, the chess grandmaster, who's also an economics professor at Harvard, was on a talk show. And he mentioned the possibility of eye-popping growth in the U.S., mentioning that there's a new momentum. We are in a better place now than 6 months ago. And that's regardless of who the president is. Even if Hillary Rodham Clinton were the president-elect, he said we'd probably be in this position. However, he also said that, or else the interviewer said that things look so good now that even the IMF may actually upgrade its economic forecasts for the first time in 4 to 5 years. Now, I don't know if Koshy agrees with that. I won't put that question to him, though. But it's not good for everybody and or every country. And of course, the two countries that whose prospects are most uncertain are probably Italy, continued downward pressure in China, the UK with Brexit, and perhaps South Korea is in there too. But we'll have to see. For Korea, one of the latest series of economic indicators that came out was the Consumer Sentiment Index, and that indeed shows a very sharp fall in households' perceptions of how things will be in the future, how they are currently and how they'll be in the future. It fell 6.1 points to 95.8. Anything lower than 100 means there are more negative respondents than positive correspondents. And driving this was mainly the perceptions on domestic macroeconomic conditions, current and also in the future. A little negativity on employment opportunities as well. However, most Koreans still are pretty positive on price stability, wages, which is a bit of a contradiction. So that's the immediate take on Korea. And then one more thing. I really don't see any negative consequences on the economy from the heightened geopolitical risks coming from North Korea. In fact, recent data on foreign investment in Korea shows that foreign investment continued to rise even in the third quarter. Of course, that was the last time North Korea tested a nuclear bomb. And foreign direct investment and investment in Korean equities has been very strong. So with that, Koshy, please.
No, thank you. Thanks
The
for
floor is
that
yours.
introduction. In a sense, I feel it's a little bit like Monty Python. Now for something completely different, because while what Tom has said is very relevant and probably the most important things to talk about today, what I want to do is, despite the title of the event, is maybe take a step back, talk a little bit about what's happening globally and also in the region, but then spend a fair bit of time on what's happening in Korea over the longer term. I think in a country like Korea, where the economic fundamentals are very strong, unlike other countries that we do cover in the IMF, much of the interest is not in short-term fluctuations, but rather in the long-term trends and what the long-term future of the economy is and what sort of policies are needed to make things even better. So before I jump in, I just want to thank Tom for having me and thank the Korea Society. It's my first time visiting, and it's a pleasure to be here. As Tom said, we did meet each other many times in the past on Sri Lanka, on Mongolia, other countries like this. So I think this is our first formal time interacting on a totally different sort of economy. So it's a pleasure. Thank you. And thank you all for being here. Why don't I just get started? And I'll start with some thoughts about what's happening in the world and what's happening in the region. And let me start with a bit of a caveat. The IMF comes out with global forecasts 4 times a year, October and January. We're right in between that cycle right now. So what I'm going to present to you are forecasts from October that were released around the time of the World Bank IMF annual meetings. We're now in the process of revising the forecast based on all the many developments that are going on in all parts of the world, including our own. So I'm not able to talk about what that forecast revision is likely to look like. It's still being discussed. But let me at least give you a picture of where we were a couple of months ago and the basis for our analysis. And that's that growth is all right in the world. We've got world growth in the left column at about 3% this year, ticking up a little bit to closer to 3.5% next year. Sort of moderate growth, global growth, and rather uneven. We've got advanced economies that are still growing pretty slowly, 1.5% to 2%, seeing some pickup in many advanced economies for next year, with the UK being an obvious exception, with quite a downward reduction in growth likely. But on the next slide, it's really emerging markets that are growing extremely fast. And we've got emerging markets growing at 4.5% this year and next, with some real stars there like India and China growing at 6 and 7%. Brazil and Russia, 2 countries that have had obviously major difficulties these last few years, seem to be bottoming out of their problems, and we're expecting some recovery. And based on that, overall emerging market averages should go up, although the China forecast calls for something of a reduction next year. And if we move to Asia, it really is Asia that's leading the way. Asian growth is in the 5.5% range this year and next. And again, China and India are there. Japanese growth, of course, is quite moderate. Where does Korea stand? Well, in our forecast that came out in our Article 4 consultation, our annual discussion of policies with the country authorities, that came out over the summer, and that forecast was carried through into our October forecast. We saw growth at about 2.7% this year in 2016 and 3% next year. That was on the basis of data basically that we had through the second quarter. Now, since then, not even looking at the fourth quarter data, just on the basis of third quarter data, there probably would be a need for a revision downward for the Korean number. 3% growth at this point seems quite unlikely for next year, based solely on the Q3 data that we've seen. And I believe the OECD just came out with a forecast revision of 2.7%. Even the BOK is down to 2.8%. So I think there's a good chance that we would come down from our 3% forecast for next year. Now, some thoughts about what's happening in Asia. Asia is a major engine of global growth. And of course, there are risks to this forecast. This forecast that I showed you on the last few slides, there are major risks here. Risks of financial dislocation, financial market disruption that could reduce growth. Perhaps the rebalancing in China will be more bumpy than we expect. That could introduce some volatility, natural disasters, political issues. These are all always risks of a trade slowdown. But I think it's useful to think about the slightly longer term, medium term for Asia. And two messages that we want to pass on. And one is that there is this risk that we've heard many people talking about secular stagnation and how advanced economies are slowing down, and this may be a new normal, a new mediocre, if you will. Well, that may have big ramifications for Asia, because Asia is, in trade channels and other ways, very highly exposed to other countries, of course. In addition, we're seeing some signs that many of the economies in Asia itself are being afflicted by some of these signs, some of these secular declines that we see in other regions. So preparing for that kind of risk is one thing that I think will be important for Asian countries. And another point is we've been seeing trade pretty slow for these last 4 or 5 years relative to GDP growth. And I have a slide that will talk about that. Well, Asia, of course, being so highly trade dependent, bears a particular risk there. And we're seeing particular weakness in Asian trade. So that also is something that makes us think that aside from the normal sort of short-term risks, there is a structural issue here. And just as China has a need to rebalance, Korea and other countries also do face a need to rebalance their economies towards different sorts of engines of growth. So let me talk about a few things that we're noticing in Asia. And it's a bit of a melange, a hodgepodge of things, but I think they're all useful observations. One is that we're seeing low inflation in many countries. And on the left, we're showing the percent of a sample of advanced economies in which inflation is low, either below 0% or below 1% or below 2%, according to the color. And you can see that almost all advanced economies now have quite low inflation. Now, if you look at Asia, across both advanced and emerging markets in Asia, we're actually seeing something similar, not to the same extent, but we've now got 60, 70% of countries in Asia with rather low inflation. That's one point. Another point, demographics. Now, this doesn't apply uniformly by any means, but there are many countries in Asia, and Korea is certainly one of them, that are going to be facing a drag from demographics. On the left, we are showing old age dependency ratios for a range of countries. And for the world, you can see that the average now, well, between the blue and the green, 2005 and 2020, is reasonably low, about 10 or 15%. But if you look at some of the Asian economies, they're much further on the right. And if you look at the red bars, you'll see that quite a substantial aging process is expected in many of these Asian economies. So in Korea, for instance, which is in the green box on the right, by 2050, we expect that nearly 70% of the population will be elderly. The dependency ratio will be nearly 70%. That is what I meant to say. And what does that mean in terms of growth? Well, look on the right-hand side. Here we're looking at the potential growth impact of demographics. And you can ignore the dots, that's with or without migration. But basically, if you look at the bars, you can see on the left-hand side of that chart, is there a pointer here?
Should be.
Should be a pointer. No? Turn it off? Okay. I won't point. I'll just tell you where to look. Close to where that red bar is, you can see the red bar is India, and to the left of it is Philippines. These are countries where we expect a definite boost to GDP growth on account of favorable demographics. Whereas on the right-hand side, we see Japan and Korea and Hong Kong, China. These are countries where we expect something of a drag. So inflation is low, demographics a drag in at least some parts of Asia. We see Asia growing in terms of GDP and catching up in terms of per capita GDP, but productivity is not doing all that well. If you look on the left at productivity as a TFP, total factor productivity, relative to US TFP, in the green line, we're showing Asia except for Japan, and it's sort of flat. You're not seeing a convergence of productivity towards US levels. And in Japan, which is the top blue line, you're actually seeing a move away from the US TFP levels. And on the right, we're just showing it in growth terms. And you're seeing in those top three lines that Japan, Korea, and the US are all growing in productivity terms at about the same rate. So you're not going to be making up any making up that distance to the frontier. China and India, which in previous years were growing substantially faster than the US, well, now they also are seeing TFP growth around the same rate as in the US. So inflation is low, demographics could be a drag, productivity is not doing all that well, and trade is weak. On the left, we have, in both charts actually, GDP growth is shown as the blue line, and export and import growth is shown in the red and green lines. And on the left, you can see for the world overall that trade growth has underperformed GDP growth for the last few years. We know that trade has slowed down. But look at the picture on the right. For emerging market Asia, the slowdown is all the more extreme. What does that mean? It could mean that Asia is being more heavily affected, or it could mean perhaps that Asia is part of the source of the problem in terms of helping to drive the trade slowdown. And here's just another chart getting at the same idea, basically making the point that for many of these countries in Asia and many of these groupings of countries, exports contribute a lot to growth, as we know. But those numbers have already started coming down quite sharply. And what does it mean for the future? Contribution of trade to growth may be weakening over time. So we already see a number of things that are sort of consistent with this idea of moving to a new mediocre, difficult demographics, productivity issues, trade, GDP. We also have some other observations, and these points, in a sense, could become even more difficult in the presence of lower growth. And one is income inequality. Asia has historically, at least many parts of Asia, Korea is a great example, inequality has been less of a problem than it has been in other parts of the world, like Latin America. But we've been seeing increases in income inequality, definitely, over the last couple of decades. China, India, and many of the other economies as well. Korea, well, the overall Gini coefficient is not too bad by any stretch, but we are seeing pockets of poverty, at least relative poverty, especially among the elderly, which we'll talk about. And how do countries deal with problems like inequality and poverty? Well, usually they deal with it either through a family network, but now with demographics changing, with the size of the families falling in many countries like Korea, there's probably more of a need to rely on public assistance schemes, social safety net. And what do we see? We say that in Asia, spending on social ventures is actually quite low relative to other regions of the world. Only less than 10% of GDP spent on social protection, health, and education put together. So the spending that can help to address some of these inequality issues, the cushion is not exactly there. Some other challenges that we face in Asia are about leverage. Corporate leverage is high. Household debt is also very high. You see it on the left-hand side. We have a chart on corporates, the share of debt that is potentially at risk in the sense that interest coverage ratios at these companies are not all that strong. And you can see that the Asian levels are quite high relative to other parts of the world. And on the right, we have a chart showing how household debt has evolved relative to GDP in a number of countries. And you can see that several Asian countries have large increases in household debt. Thailand, Malaysia at the top of the list. Korea is also there, one of the green bars that you'll see on the right-hand side. So these also are sources of vulnerability, and I think particularly sources of vulnerability in a context of slowing growth. So what does this all mean for policy? These are observations, interesting or not, I'll leave it for you to judge, but the point is, what do we do with these observations? What does it mean for policies? Well, how about monetary policy? There is a case, definitely there's a case for loose monetary policy in many countries, accommodative monetary stances. Look on the left. We see that in many countries, in Korea, we've had the inflation target undershot for nearly 4 years, more than 40 months. In New Zealand, in China, and Thailand, similar sorts of ideas. So inflation, as I said before, has been quite low. And on the right-hand side, there's a chart showing countries, a scatter plot of countries according to their output gap, how far GDP is short of potential GDP, and credit gaps, whether credit is booming in the country or not booming in the country. And basically, if you go further to the left, you have larger output gaps, and you would say, well, there's a need for monetary stimulus, monetary support to help support the economy. And certainly there are many countries with negative output gaps that could perhaps have some role for monetary support. On the other hand, many of these countries are in the top left quadrant, meaning that they have a positive credit gap. Credit has grown above what we think are equilibrium sorts of levels, which means what? We have to be a little bit careful about giving the monetary stimulus and goosing up credit growth. It also raises questions of what the right balance is between monetary policies and other policies like macroprudential policies that can be used to curb some of the financial stability risks that could otherwise emanate from monetary easing. So there is a case for monetary accommodation, but you have to watch out for the financial stability aspects as well. What about fiscal policy? Well, do we need fiscal support? And do we have the space to give the fiscal support? That's what these two graphs are trying to show. On the left, we're talking about the need for supporting aggregate demand. And we're showing a scatter plot of Asian countries according to their output gap and according to their current account balance. So if you see countries which are in the lower left corner, they are countries with large output gaps. They're falling short of potential GDP. Sorry, upper left. And also have very large current account surpluses, which could indicate that imports are quite weak, another indicator of weak demand. So countries that are in the top left here probably have more of a case for fiscal policy to support demand than countries which are towards the right. A country like New Zealand, for instance, it doesn't really have an output gap, and it doesn't really have, well, the current account doesn't either give that signal. Notice two countries here, Thailand and Korea. They both have negative output gaps. They both have rather sizable current account surpluses, which could indicate that there's a need for fiscal support to support the economy. Do those countries, however, have the wherewithal to do this fiscal stimulus, or are they simply out of space? That's what the chart on the right tries to get at. It shows countries according to their debt levels on the horizontal axis, and also a measure of how easy it is for them to finance themselves on the vertical axis, their CDS spreads. And again, countries here, the orientation, if I had been cleverer in arranging these, I would have had the orientation aligned. But in this chart, the top right are countries where financing is difficult and debt is at very high levels. So you wouldn't think that India and Vietnam necessarily have a lot of fiscal space. On the other hand, countries in the lower left have more fiscal space. And think about those two countries we talked about before, Thailand and Korea, with a need for fiscal support. Well, we would argue they also have the space to give fiscal support. General government debt is in the 40 to low 40% range for both of these countries. Korea, it's right around 40. And financing is not really a difficulty at all. So why not give a little bit of fiscal support to support the economy? And then, of course, structural policies. You know, when we talk about structural slowdown of the economy, you can't solve that with a little bit of fiscal and monetary stimulus. There are underlying causes that have to be addressed. Product market reforms, infrastructure investment, labor market reforms, all sorts of difficult things like that that need to be introduced. And on the right, it's just an indicator from the OECD that shows how responsive different countries have been to structural reform advice that the OECD and others have given. And you see there's, this is an index, but you see there's a bit of a range. Some countries have been more responsive than others. On the right, the only point I'd like you to take away from this is that China and India, two major Asian economies, are getting relatively good scores from the OECD in terms of their reform responsiveness. And we hope that that sort of impetus to do strong structural reforms will continue in the region. Now, let me get to the part that probably is most appropriate for Korea society, namely the part on Korea. And here, I'm afraid I won't say much about the short term. I won't say much about, I won't say anything really about political issues because we are an economic organization and we don't get into those issues. But as I said, I think the really interesting things in Korea are about the long run and where the country has started from, where it is today, and what's going to happen in the next 20, 30, 50 years. At the IMF, we work on lots of different countries, and it's sad to say that in many of the countries, problems repeat themselves. You have a balance of payments crisis, you have too much fiscal spending, you have a credit boom that then leads to banking crises. And you go and you give advice, and the governments are very knowledgeable and implement good policies. And then 5 or 10 years later, you often see countries repeating these same mistakes. And I don't want to say that Korea is different, but it sort of is, because Korea has had a 50 or 60-year track record now of massive success. I don't need to tell any of you that. But Korea in the 1950s was running at a per capita income level that was 5% of the US's. And now the per capita income is about 55 or I think 60% of US per capita income. There's been massive convergence. Korea really is the kind of country where I think people at the IMF have to be humble and say we have a lot more to learn from the government than we probably have to tell the government, because they've had this sustained track record of success. This chart shows this idea of growth convergence. We're showing countries according to their income levels on the horizontal axis and according to their growth rates. So poorer countries generally grow faster. This is the idea of convergence. And once you become richer, it's tougher for you to grow very fast because you're already pretty rich. And you see this pattern. So for countries between 0 to 10,000, 10,000 to 20,000 and up, you see that the scatter plot sort of slopes downward. Now the green line tracks Korea's performance through the decades. In the 1980s, Korea had a per capita income that was around $5,000. And then in the 1990s, it was in the low 10,000s. In the 2000s, it was low 20s, and now it's in the around the $30,000 mark. And in each of those cases, look at where those dots lie relative to all the other countries in the sample at that time. Korea is at the top. Korea is always one of the top performers for even adjusting for its income level. So it's a good performer. And I think we always have to keep that in mind. It is a good performer. It has been a good performer. And it remains a good performer. And hopefully, if policies continue in the same sort of direction, it will remain a strong performer, even as it continues to grow in income terms. Those horizontal bars show the top 10 percentile, basically the top group of countries in each bracket. And you can see that Korea is in that top 10% every time, or nearly every time. So this is a nice chart, I think. It presents a lot of information about Korea's own history and about the cross-country perspective and about the relationship between income levels and growth. But people don't usually look at it this way. People, I think, especially when we meet our friends in Korea, they look at a much simpler chart. They look on the left and they say, well, look, in the 80s, we were growing at 10%. And now we're growing, and then we were growing at 7%, and now 4%. And well, this year it's maybe less than 3%. What's happening? There's something major that's happening wrong in our economy. We're on the wrong track. Korea has a bad future. People worry. It's really not the right perspective to take. I was hoping that first graph would show the context, that Korea actually is a very strong performer. But if you just look at the growth numbers, of course, there has been a decline. And I don't think it's realistic for us to expect that Korea is going to get back to 7% or 10% growth anytime soon. It's now an extremely rich country compared to most in the world. And this chart I showed on the right is just showing convergence relative to US GDP, as I said before. So you can argue that convergence has slowed. The slope of the line, it was very steep in the 90s. Then you have the Asian crisis. Relatively steep after that, global financial crisis. And then after that, it's sort of flattened out a little bit. And that also is a source of pessimism. So I think we have to have the right perspective, but it's also legitimate to ask, why has convergence slowed? Is it going to continue slowing? Is there anything we can do about it? Maybe we won't get back to 7 or 10% growth, but can we get back to 4 or 5% growth? Are there policies that could help in that? And I think that's what I'd like to talk about for the rest of the presentation, which is not very long, don't worry, in the few remaining slides. One major drag that Korea has going forward is its demographic structure. And you'll hear that many of the things I'm going to say now are going to echo what I said in the general part about Asia. Korea really does fit that model. Again, on the left, the old age dependency ratio for advanced economies is this black line increasing slowly. Japan and Korea increasing quite sharply. And you can see that Korea is basically 20 years behind Japan, but it's exactly the same pattern. And pretty soon, in a couple of decades, Korea is going to catch up to Japan in terms of old age in the population, which is both a good thing and a bad thing. It's, of course, a marvelous thing. I hope to live that long myself. But it also means in terms of contributions to the labor force, contributions to the economy, it's going to be a different sort of economic structure. So looking forward, what does it mean for potential growth? We have to make some assumptions about what labor force participation is going to be in the future, and I'll get to that in the next slide. But even if we assume that that policies can be used to promote increased labor force participation, the fact that there is a declining number of people in the right age cohort to join the labor force means that the potential growth of Korea is likely to decline. And it's quite a strong force, and it's difficult to do much about that. You see on the right-hand side, potential growth at about 3% now, forecast to drop to the 2.5% or maybe slightly lower than that range over the next few decades. This is, frankly speaking, quite a passive forecast. It's difficult for any economist, I think, to say what's going to happen to productivity growth 20 years from now. So you can see that our blue and gray segments, the contributions from capital accumulation and from productivity growth, we've basically done a passive projection. And the one thing that is not passive here is we've built in the demographic trends. And whereas labor, the growing labor force, was contributing to growth in decades past, going forward, the red bars turn negative, and it's likely to be a negative contribution to growth, pulling potential growth down. Not massively. I'm not saying growth is going down dramatically, but there is definitely a decline that can be expected. That is one challenge that Korea faces. And policies can do something about it. Namely, we can try to do something about labor force participation. You may have fewer people in the right cohort, but you can get more of them to work. And the logical place to start is with females, because female labor force participation in Korea is reasonably low compared to OECD standards. The blue line is below the orange line in the left-hand side. On the right, we see that among the youth, the employment rate is also quite low for Korea. Korea has this red bar. I'm sorry, this is badly formatted, but Korea has the red bar towards the left. Youth employment is quite low, and what I haven't shown you here is that youth employment has also been declining in recent years. So if things can be done on this, that's one dimension on which policies can help to act in order to induce females to participate more, try to make opportunities for youth employment, to try to offset these demographic trends. Another challenge that I don't need to tell you about is labor market duality. There are regular workers who are highly protected, and there are non-regular workers who don't have similar protections. And while it's good to have flexibility in a labor market, having an extreme type of segmentation that is there in many countries, like Japan, like Korea, can be a difficulty for an economy. It can be a difficulty in two aspects. One, the temporary and irregular workers generally have lower incomes, and this sort of arrangement can contribute to inequality in the society more broadly. But even in terms of efficiency, if you're a company and you're hiring irregular, perhaps temporary workers, your incentives to invest in their human capital accumulation are much weaker. So productivity for the economy as a whole can go down if you have a large preponderance of temporary and irregular workers. So doing something about this segmentation, which I know has been something the government has tried to do and has been a major focus in the past, that could be something that could help to boost potential growth, definitely. And here's this point about productivity. Well, we saw this TFP chart before, but on the left-hand side, I just wanted to add the thought about labor productivity. If you look at GDP per hour worked for a sample for the OECD countries, Korea is middle of the pack, but it's below the average. So median, but not mean, I suppose. And that may have something to do with some of these other factors that I have mentioned, including the share of the labor market duality. And where do we see the productivity lagging? And here I'm taking stuff from our OECD colleagues. We see productivity lagging, especially in the service sector and among the small and medium enterprises. Now, the service sector, this is a chart from the OECD that normalizes according to manufacturing. In the OECD as a whole, the service sector productivity is 90% of manufacturing productivity. In Korea, service sector productivity is maybe only 40 or 45% of manufacturing productivity. Partly that's because Korean manufacturing is very highly productive, but it also is because there are constraints, barriers to entry, high degree of regulation that get in the way of service sector productivity. If you look at small and medium enterprises, just a couple of charts showing labor productivity, output per worker or per hour of labor, for very small firms with 1 to 9 employees, and smaller or medium enterprises from 50 to 250 employees. And on both of these scores, Korea is right at the bottom in terms of labor productivity. So productivity issues, especially for the especially for the service sector and for SMEs. Now, what is the issue with SMEs? There are many issues with SMEs, and I have a very strong suspicion that many of you know this much better than me, so I won't go into details, but there are some interesting charts that we have. I think these also are from the OECD on incentives for entrepreneurship in Korea and other countries. Are there barriers to becoming an entrepreneur? And it's an index. And on the right-hand side, a survey question where they asked respondents, what do you think of entrepreneurs? Are they held in high esteem? Is it something that is socially valued by your parents and your colleagues and your friends? Or is it something that's not? And we see for Korea in red that the barriers to entrepreneurship, measured according to this index, are quite high. Access to finance, access to advice on how to start businesses, things like that, regulatory problems. The barriers are quite high, and the image of entrepreneurs is not all that high. Many people would like to have a steady government job, or they'd like to work for Samsung or for Hyundai or something like that. If you have this constellation of high barriers and low image, then it's less likely that you're going to have people striking out on their own, opening up these small and medium enterprises that could be a good engine of growth for the economy. And then another issue that is a challenge for Korea going forward. Of course, one of the major sources of Korea's success was its export orientation over these many decades. But now in a world where trade is slowing, that may not be such an advantage. And it may be something where some rebalancing is needed. We showed this chart before. Contribution of exports to real GDP growth in a number of countries, including Korea on the right-hand side. And you've seen some declines in recent decades. And just a line chart on the right showing that Korean exports have been not performing all that well in recent years. Beyond this issue, there are also issues with the corporates and with household debt. On the right-hand side, Korea has one of the highest household debt figures in the OECD. And I'll get back to this point when we talk about the fiscal position, because at the same time that it has very high private debt, Korea has very low public debt. And one question to ask is whether this is the right mix, this is the right approach, right way for a society to bear risk, whether there could perhaps be more of a role for the fiscal, for the government to take on more risk, take on more debt, and leave individuals to take on less debt. That's one question. Left-hand side, another chart about the interest coverage ratio, essentially looking at not the very tail, but it's slightly weaker firms in the distribution. So you look at all the firms in a number of different countries, and for each country you look at their 25th percentile. Not the absolute weakest, but one of the weaker firms, some of the weaker firms, in terms of how well their earnings cover their interest payments. And then let's see what those ICRs, interest coverage ratios, are at that weaker end for a number of countries. And you can see that Korea has some weak firms there. The way we've shown it is not to show the aggregate, because in aggregate, Korea's corporate sector is actually very healthy. But the point I'm trying to make is that there are pockets of weakness that need to be dealt with, and sectors where there are particular weaknesses, as we know, shipbuilding and shipping. And the last point, before I get to some policy issues, poverty. If you look at relative poverty, this again is from the OECD. And in the footnote, it says, relative poverty is measured by reference to median income. So deviations from median income. Relative poverty for Korea versus OECD countries on average, about the same in all age cohorts. But for the elderly, substantially higher. Nearly 50% of Korean elderly are relatively poor, relative to the median in Korean society. And it's not to say that Korea is an unequal society. It's not by any standard. But this is something of an issue. And Korea started with land reform and free access to education and this marvelous history of equitable growth over the many decades. And now that picture is changing slightly. And for some groups, changing quite sharply. What does this all mean for policies? Well, for the short term, which I didn't talk much about, but it matches what we've said for other countries, macro policies should be accommodative. There's no reason why monetary policy and fiscal policy can't provide a little support, and the authorities have been doing that. We've heard about recent fiscal stimulus packages. One can argue whether they're large enough or small enough, but they're moves in the right direction. Some of these longer structural issues that are difficult for the economy, well, it just means that structural reforms are needed. They're not going to be solved, as I said before, with a little bit of fiscal stimulus or monetary stimulus. You have to do the difficult product market reforms and labor market reforms, fixing corporates in difficult sectors, dealing with household debt through macroprudential policies and other reforms. But the point I want to focus on is the role that fiscal policy can play. Korea has very low debt. And over the next few decades, we expect debt is actually going to decline. I think I have a chart of this. This chart is not very well done, but debt is around 40% of GDP. And I haven't shown 2030 here in the bars, but debt is expected to drop to about 35% of GDP on the Korean government's current fiscal plans, which assume the deficits will come back down again. Now, if you look at the long term, there are pressures. But we would nonetheless say that there's scope to use fiscal policy to achieve better macro outcomes. So what do I mean? There are really three things that I mean. First of all, as I said before, you can certainly do some short-term fiscal stimulus to support the economy when you're facing an output gap, when imports are very low, when current account surpluses are very high. There is some justification for having fiscal stimulus in the short term. That's the first point here. Second point is that fiscal policy can be a handmaiden to the structural reforms that are needed to boost growth in the long run. We say structural reforms as if they're this wonderful thing, and they are, but of course there are lots of short-term costs. If you do corporate restructuring, if you try to move workers from one type of labor contract to another, there are dislocations, there are people who are affected. And fiscal policy can be used to support those people in order to bolster their standard of living, make sure that they're not adversely affected, and also to build political support for the sorts of structural reforms that are needed for the overall economy's long-term growth. So it can be used to cushion the effects of structural reforms that may be negative in the short run, even though they're very positive in the long run. It can also be used to incentivize some of the structural reforms. We talked about inducing higher female labor force participation. One way to do that is to provide better childcare, maybe better credits for tax credits for birth of children, things like that. That's not for females, but that's for boosting labor force growth. But the third thing, aside from short-term demand management and aside from going hand in hand with structural reforms, we think there's a very important role that fiscal policy can play in terms of increasing social spending. Look at what's happening in Korea. We've got many elderly people who are at least relatively poor. We've got social spending that is very low by OECD standards. On the right-hand side, we show social spending by the public government as a share of GDP. The OECD average in orange is around 22%. Korea stands at 10%, just 10%. And partly that's because Korea started many of these systems only very recently. The National Pension Scheme started in 1989. The basic livelihood income support started, I think, in 2005. Korea has not had the time to mature. The number of beneficiaries has not grown as it would have in systems which have been around for longer. And the benefit levels may not be as high as they are in some of those other countries. Now, what does that mean? Well, we have issues with inequality, among the elderly especially, poverty. We have an issue about a need to boost consumption and to move away from this export-oriented growth model, move towards consumption, have less savings, and have this domestic engine of growth. We also have this issue of household debt. And one channel that we've heard many people talk about is that actually some of the household debt that's being accumulated is by households headed by people in their early 50s who are let go from their jobs. And then in order to supplement their retirement income, they open up a small enterprise, maybe a chicken restaurant or something like that. And often they'll borrow in order to start that restaurant. That's part of the contribution to this rising household debt, which poses all sorts of economic and financial risk. That sort of borrowing would not be needed if the social safety net were stronger. So one could make an argument, it may be pushing it a little bit too far, but one could make an argument that increased social spending could not only directly address inequality and not only help bolster consumption-led growth, but could also do something in terms of addressing financial stability risks. And this is what I'm trying to say at the top here. Now, when we make this argument to the Korean authorities, they come back and say, well, look, you're taking a very short-sighted view of the fiscal. You're looking at debt today. And yes, debt is low. But we face massive fiscal pressures over the medium and long term. We've got, as I showed you already, we've got the most rapidly aging population in the world. And within some decades, we're going to see this 10% of GDP automatically rise to about 30% of GDP. So it would be very foolish, they argue, that for us to think about increasing social spending in a discretionary way now, because we're just going to dig a bigger fiscal hole for us some decades down the line. Then there are other issues. I mean, there is, of course, the issue of reunification, potential reunification with North Korea. If and when that happens, look at how much West Germany spent in terms of fiscal outlays when reunification with the East happened. And North Korea has a far larger, the relative population size, North Korea versus South, is much closer than it was East Germany versus West Germany. And the income differential is much larger for North and South Korea than it was between East and West Germany. So one could argue that the German experience is actually a dramatic underestimate of the sort of fiscal costs that Korea may face. And therefore, it's prudent to prepare for that sort of risk in the future by running very tight fiscal policy. And along with that, very large current account surpluses. This is part of the reasoning. I think we agree with many of those ideas, but I think it's a matter of how you calibrate it. Yes, if we were being told that social spending is going to rise to 30% within the next 5 years, or next 10 years, then sure, we wouldn't make this argument. But in fact, the projections are that social spending will rise to 30% by 2060. That's 50 years from now, 40 years from now. So in the interim, we have 4 decades during which we're achieving suboptimal macro outcomes in terms of too low growth, too low consumption, financial stability risks, inequality. All these things could be addressed with little extra social spending. That's part of the argument that we're trying to make. So what then, you may ask, do we do 40 years from now when the problem comes about and we have to deal with these fiscal risks that we have irresponsibly created by increasing fiscal spending now, social spending now? Well, we are totally agree that something has to be done. You can't simply increase spending and never have a backup plan in order to be fiscally responsible. We agree something should be done. But of course, a policymaker now can't say, I'm going to increase social spending, and 50 years from now, somebody else is going to increase taxes. That argument doesn't work. Time inconsistent, as economists would say. But what could work is to introduce some kind of fiscal rules. You could say that Korea is not going to have a debt level above X% of GDP. And I'm not talking about a level of 40% or 35%, because that would give you no flexibility at all, but some number that's slightly higher than that. And you would say, we're going to allow some increased spending. And if and when we actually reach a point where debt comes to that level, then policymakers at that point would be constrained to follow the rules, and they would have to do something. Maybe they would cut some other spending. Maybe they would raise some taxes. We don't have to think about that now, but it is true that Korea has relatively low taxes relative to most other OECD countries. So that is one option to look at, but leave that to the policymaker of the next generation. The point is, you allow better social spending now, a stronger social safety net to deliver better outcomes right now, and you set up fiscal rules in order to ensure that the long-term sustainability issues are there. So I think I'll sort of end with that, but maybe I can just summarize by saying that we really see Korea as having lots of potential, continuing to have lots of potential. There are, of course, big challenges that they face, but structural policies and fiscal policies can help to overcome these things. And I think the Koreans are very much on that track, and we're looking forward to seeing how it all pans out. Thank you.
Well, thank you, Koshy. That was certainly a tour de force. We'll get to questions. Hold on a second, please. And before we get to questions in the audience, I just wanted to make one statement, and I do actually have a question for you, Koshy. He has a train to catch at 3 o'clock, so we do have a constraint. If you didn't have that train, you brought up so many fascinating issues. I wish I could spend a couple of hours to talk with you, and maybe Koshy, and maybe some of you in the audience too. But the first, my observation about fiscal rules. I see a colleague from Moody's, his ex-colleague is here too. I'm not sure if she shares my view. I think she does though. But we've noticed that fiscal rules tend to be broken because new politicians come in and they don't feel, particularly in a democracy, they don't feel beholden to those rules, or else there's a big economic dislocation or a recession, and then you have to spend more, and it's hard to ratchet down spending afterwards. At any rate, if Korea were to introduce a fiscal rule, this is one country where I think they would adhere to this rule.
Overperform, probably.
Probably overperform. Looking at the track record of Korea, because whether the government has been conservative or progressive, both the government under presidents in those two camps maintained very prudent fiscal policies. Yeah, and a fiscal rule, I would give Korea credit. I would say that Korea would have credibility. My question though is on high household debt, and it seems to be the policy prescription you are edging towards is that the government should increase entitlements. I can see the logic there. If the government's handing out money to somebody, they won't need to go to the market and borrow the same amount of money, perhaps. But I wonder if there's another solution, because I thought it was your presentation, but it's probably a presentation I saw the other day. It showed the rise in household debt through the advanced countries, maybe the OECD countries as well. And in the case of the U.S., household debt went up before the global financial crisis and then went down after. It's only one of the few countries where this has happened. But it happened, my understanding, because banks wrote off household debt. It wasn't that people saved and repaid their loans voluntarily. That did happen, but there were a lot of write-offs. So what near-term policy prescription does the IMF have, or does it have one for addressing the household debt issue?
Well, look, I said I didn't want to overstate my argument that that social safety net reform is going to be the magic bullet that solves everything, silver bullet. And I really don't think that is the principal policy prescription we would make for this household debt issue.
Right.
I think for that, we would be talking about macro-proof.
Right.
Korea has very loan-to-value ratios are quite reasonable, very similar to other countries. Debt-to-income ratios are extremely high in Korea. I think they're around 60%,
Right.
Whereas in many other countries, they're in the 30% range. That sort of tightening could do something, and the Koreans have already taken many steps along the way.
Well, thank you all for coming today, and thank you, Koshy, for
Thank you.
giving us this lecture.
Appreciate it.